I want to introduce myself and Jennifer. So my name is Leanne Medore, and I am a sales counselor here at Birch Hill in Manchester, New Hampshire. And Jennifer Rivett is a attorney and shareholder at Divine, Millimet, and Branch. She works closely with individuals and families to understand their estate planning needs. So she's going to be doing our presentation for us today. So we will start with doing a few housekeeping details. So you are on mute. Everyone is on mute right now except for myself, but we welcome questions. So on the bottom of your screen, there's a Q&A. So if any questions come to mind, feel free to type them in that little chat feature down there, and we will answer them towards the end of the presentation. You also can offer suggestions on how we can improve or how we can host a different topic. If you have any ideas, let us know. We would love to hear that from you. And again, this presentation will be recorded to view again and share with family or friends at the same time. So like I said, my name is Leanne and I work at Birch Hill. We are part of the Riverwoods group, or as I like to say, the Riverwoods family. Riverwoods Exeter started over in 1994. They now have 3 campuses over there. They have the Woods, the Ridge, and the Boulders. Most recent one was built in 2010. Birch Hill joined the family in 2016 as part of the Riverwoods group. And then Riverwoods Durham actually opened a little over a year ago now at the end of 2019. That SPE that you see there stands for someplace else. So they're always keeping in mind where we might be able to bring our brand and our program to in other parts of say New England or maybe someplace else, who knows, but it's bringing that piece, that Riverwoods community to other areas. So what is a CCRC? So a CCRC stands for Continuing Care Retirement Community. And what that actually is an insurance product. So we have a contract to offer people, and it's regulated by the state of New Hampshire. And we also have to report our financials to them each year, annually. When you join a CCRC, you are prepaying and insuring your care for the future. So be it assisted living needs, nursing care needs, or sometimes in our case here at Birch Hill, memory care needs as well. A portion of that entrance fee that you pay once, and monthly fees are tax deductible. So a good example for this past year, 2020, 100% of the non-refundable portion of that entrance fee was tax deductible, and 8% of the monthly fees were tax deductible. So that's nice that there's that piece in there as well. But beyond ensuring your care for the future, we're also a lifestyle choice. So residents move in when they're independent, and it frees you up from all those things you don't want to do, chores, maintenance. You leave that all to us. We take care of those pieces for you. If you need transportation, we're happy to provide that as well. Cook some wonderful meals, and there's a lot of activities and events and programming to take advantage of here at Birch Hill. So, but really what I think is so important in the lifestyle choice is your increased social options, because good relationships just keep you healthier. So you gain all that, you stay in control of your life, and you and it's also the insurance product at the same time. So CCRCs answer the question of cost, quality, availability, and location of what you're going to do in your future. So CCRCs, there's a few pieces to know about it. So you must enter when you're independent. So you cannot join when you think you're ready, and because sometimes that can be too late. So you have to be able to live safely on your own. You do have to be at least 62 years old. And as I said before, you got to provide 3 different levels of care. So people enter as independent, knowing that we have assisted living care, nursing care, and some also have memory support, such as Birch Hill. The residents can transition between levels of care within the same community as your health needs dictate. There are services and amenities at every single level. So there's the care that you need according to the level that you're in. And you typically have 2 fees, like I said, the entrance fee and the monthly fee, a portion of which are both tax deductible. So you meet new friends and have time to pursue interest in hobbies and what you want to pursue. Being part of in a CCRC, you also need to know that we have benevolence, which means that we are not for profit. We would never ask you to leave the community if you ran out of funds through not doing that intentionally. So there's a piece here where we would not ask you to leave if you ran out of money. So about Birch Hill, we've been in Manchester for over 100 years. We did start as what's called Pearl Manor, which was assisted living. And we've had many different phases throughout our lifetime here. We've been Hillcrest Manor, Birch Hill Terrace, and right now we're just Birch Hill. Our Manchester's only CCRC, and we joined and started that in 2009. Like I said, we became a part of the Riverwoods family in 2016, and we are a Type B contract. So that kind of is what is different for us in the Riverwoods family, is being a Type B. They are a Type A, and I'll talk about that Type B in a minute. We have recently completed all of our interior renovations, but there's lots more to come. We are now working on the outside of our community. We have been doing renovations for about 4 years plus at this point. So because of that, we have immediate availability where people are moving in over to the healthcare piece of our community, and we renovate an apartment and then it's available for people to join us. We are located in a beautiful country setting. So we are not in downtown Manchester. We're 10 minutes away from that. We're about 20 minutes away from Concord. We have a nature conservancy right across the street, and it's got 600 plus acres. So we're a worlds away from more dining and shopping needs, but we're up in this beautiful part of country setting in Manchester. Birch Hill has what they call an innovative flexible contract. It's the first of its kind in New England. So what does that mean? It's a flexible contract. You can use, if you would like to use that 70% of your refundable entrance fee during your lifetime to offset healthcare costs. So you have an option, you have a choice. You can maintain that 70% to be go to your state when you leave the community and your unit is sold. Or if you want, you can use it to help during your lifetime to offset your healthcare costs. So it's more affordable. You have lower entrance fees because we're Type B when you join an independent, monthly service fees, and your service fees only change when and if you move to healthcare. It is a great value for couples. Second person is a very low entrance fee and monthly fee. And this has asset preservation. So it does provide great predictability of cash flow during your lifetime. You can also use your existing long-term care insurance. If you have that, it's a fantastic benefit with a Type B contract. You can use that towards healthcare costs. You simply pay us and then you submit your bill to them for reimbursement. You have access to your money during your lifetime versus a simply asset preservation. So if you want to, you can use that 70% piece to pay the difference between your independent care costs and your costs for healthcare when it changes. So you're predictable, flexible, and a great value with our contract. So what about COVID? I always call this the elephant in the room. But as a CCRC, we are better equipped. We have professional nursing staff. We have RNs and LNAs. We have a fantastic housekeeping staff that is sanitizing hallways and public touch areas constantly, plus keeping independent residents' homes clean. We have access to PPE, the equipment that's needed. We have sanitizing stations at the entrance, also scattered throughout the building. There is testing that when anybody walks in that does not live here, employees and anybody coming in to assist has to take their temperature and answer a series of questions before they come in. And we are also in process with our vaccination clinic. So we did this past Tuesday, just have our second clinic. So our independent residents have had their first vaccine that wanted it, and healthcare residents have had their second vaccine. You have great access to community. So you are in a community where there is support and healthcare. Should you need it, people are here to help you. We also continue to provide meals. We deliver groceries. We deliver your mail. Any prescriptions that you need are delivered here when we get them to you. So all that has been very helpful for the residents that lived here during this time of COVID. We also have the on-site healthcare clinic. So we have a wellness clinic where they have drop-in hours where you can schedule appointment. And our nurse practitioner, Vicky's been checking in on people. So it's all that support that is just wonderful during this pandemic that our residents have had in this past year. So now I am going to turn it over to Jennifer, and she's going to take it from here.
Thanks, Leanne, and good morning, everybody. As Leanne mentioned, my name is Jen Rivett, and I am an attorney, not an accountant. So today we're going to talk about taxes and how those play into your estate plan. So this will be a pretty high level discussion. Happy to answer questions at the end. Oftentimes with tax related questions though, if they're really specific, my answer tends to be go talk to your accountant. So I'll caution you now. But in any event, taxes are an important part of your overall estate plan. And if you were with us earlier this week, we had talked briefly about estate planning documents in general. And during that discussion, there were a few times where I said, you can do some estate tax planning with your estate planning documents, and we'll talk about that later. So here we are. As far as just a brief review of what an estate plan includes, it's a series of documents. Typically there are wills. That's one thing that we always think about with respect to estate plans. There are also trusts, and we're going to talk a bit more about trusts and how they can be a component in part of making sure that your estate passes to your next generation in a very tax efficient manner. Nobody wants to pay more taxes than they need to, right? Estate plans also include powers of attorney, which can be an important part of not only your estate plan, but can play into your tax planning as well. And gifting is something that we didn't really talk about when we talked about estate planning in general, but that is also an important component of an estate plan and can be very useful, particularly if you have larger estates. So we'll start with the federal estate tax, and this is actually something that you might start hearing a little bit more about as we have had a shift in Congress and the presidential administration, and taxes seem to be on the mind of a lot of folks making some decisions. And the federal estate tax is one that comes up quite a bit in discussions. Right now, we know the following. So each individual US citizen has an exemption from the federal estate tax. And right now it's a pretty large number. So this $11.7 million figure means that $11.7 million of your overall estate can pass free of any federal estate gift in what we call generation skipping transfer taxes. That number is indexed for inflation annually. So it's been slowly ratcheting up over the last few years, but our current laws say that in December of 2025, that overall exemption amount is going to drop back to a $5 million per person exemption amount. Still a pretty significant amount that you can pass free of federal estate gift and generation skipping transfer taxes, but it's significant change if you are in that upper echelon of wealth. So we're doing a lot of planning right now for wealthy folks who want to take advantage of the laws as they stand right now, knowing that that amount may drop back down. Anything above and beyond the $11.7 million threshold is taxed at a rate of 40%. So it's a pretty hefty estate tax that is assessed on someone's estate when they've passed away. Married couples can combine your exemption amounts, so I'm going to talk a little bit more about that in a moment. And as a word of caution, even if you are not in the $11.7 million and up range, you may have connections to a state that still has estate taxes at the state level. Here in New Hampshire, we do not have a state level inheritance or estate tax. Every other New England state does, and depending upon the type of asset that you may have connected to that state, primarily real estate, you may not have a federal estate tax problem, but you may have a state level estate tax problem or liability that we want to or can try to plan for or plan around. Other states, I believe there's about 12 of them right now that still have state level estate taxes, and the exemption amounts vary quite a bit from state to state. So the federal estate tax, as I mentioned, with the current change in administration and Congress, there's been some discussion about possible changes. So again, we're planning with folks who want to take advantage of the laws as we understand them right now. But what may happen other than going back to our prior exemption amount is that the exemption amounts may change before then if Congress passes some sort of tax law. The other important thing about the federal estate tax that I'll touch on just right now briefly is there's a benefit to passing assets at death. So we have what we call a cost basis in every asset that you purchase or own or inherit. And generally speaking, if you purchase an asset, your cost basis in that asset is going to be what you paid for that asset. So you bought a house for $100,000 20 years ago, that's your cost basis in general. If you sell that asset, there is a gain, presumably. So your $100,000 house is now worth $200,000. So you have a gain of $100,000. There may be capital gains assessed on that gain, capital gains tax, assessed on that gain. If, however, someone inherits an asset, that $200,000 asset is now, worth $200,000 when you pass away. The person who inherits the asset is assuming the new cost basis. There's a step up between your cost basis and now we get to the current market value of that asset. That's the cost basis of the inheritor, the beneficiary. So if they went around or turned around, and sold that asset, their gain would be zero. So, that's kind of a nice benefit under our current federal estate tax law. And there's been discussion that may go away. We only know what the law is now. We can speculate all day long, but we're going to work with what we know. So what is the federal estate and estate tax? So essentially it's your gross estate, the total value of everything that you own at your death: real estate, financial accounts, stocks, bonds, business interests, life insurance. So everything that you own is part of your federal estate. The net of that, we reduce your estate by deductible debt. So any mortgages, credit cards, other debts and obligations that you may owe. Funeral expenses can be removed from your federal estate tax and deducted. Certain medical bills, certain administrative expenses, accountant fees, lawyer fees to help settle your estate, and any transfers to a spouse who is a US citizen. So that's really important as far as if your spouse is a non-US citizen, you may need to engage in some additional specialized planning for the federal estate tax. So portability, as I mentioned before, what this means is that married couples can combine their exemption amounts. So together you can pass $23 million in change free of federal estate, gift, and generation skipping taxes. The idea behind portability, however, is that it's applied only to the federal estate tax. And it eliminates the need for some really complex estate tax planning using trusts and dividing assets between two spouses and preserving each other's exemption amount. So under our current law, we don't have to do as much of that complex estate tax planning. There might be other reasons that we want to use trusts and separate trusts and divide assets between spouses. But if we're using the straight portability option under our current tax laws, we don't need to engage in as much complicated tax planning. It really only applies to the federal estate tax, as I mentioned. And even if you are not above the threshold for filing, but you want to utilize the portability option and preserve the spouse's unused exemption amount, really what that requires in an estate tax filing. So again, with respect to planning and more the administration of a trust or a person's estate after they've passed away, the discussion about whether or not you should utilize the portability option under the estate tax, federal estate tax law, is really a discussion that you should have. It may not apply, but it's worth having the discussion with your counsel and accountant. So then we have the gift tax. And the gift tax is essentially taxing gifts above and beyond a certain amount. So it always begs the question, what is a gift? And that's pretty simple, right? I give something to someone else. I don't expect anything in return. That is a gift. There are also things that are not gifts, but are given with the intent of benefiting someone else. So for example, certain gifts that are not subject to the gift tax are tuition bills or medical bills that you are paying on behalf of someone else, that you are paying directly to the educational institution or directly to the healthcare provider or medical institution. Where that can become really helpful and important is that we have what we call the lifetime exemption, that $11.7 million that you can pass free of gift taxes over time. There's also an annual exclusion amount. So you might have heard of this, you can give $15,000 per person per year. And that is true. That changes on an annual basis, but it's been $15,000 for quite some time because there are formulas that say we only increase by $1,000 and it's tied to the inflation rates. So right now it's still a $15,000 per person annual exclusion amount. And what that means is you can give that amount or less free of any gift tax. You don't even have to file a gift tax return. You just write the check for $15,000, no reporting required, and it does not reduce your lifetime exemption amount. So we're not chipping away at that $11.7 million exemption amount. So annual exclusion gifts are wonderful. They're great. It's a nice way to get assets out of your estate and still see people enjoy the benefit of your gifts during your lifetime. However, you may decide that you want to pay tuition for a grandchild, for example, or you have, a child or grandchild who needs some medical care, and that's above and beyond $15,000, right? So you can make the gift directly to that institution and pay somebody's $40,000 tuition bill. Again, it's not a gift for reporting purposes. We also use gifts in complex estate planning where we have large estates where we want to gift assets out over time or perhaps to a trust to control how those gifts are used. Maybe we don't want to make an outright gift to someone. We want to make that gift to a trust to be sure to be able to control how those assets are used in the future. It also removes any appreciation from your overall estate. So if you do have a large estate, you make a gift of stock that's going to continue to increase over time, or real estate that's going to increase in value over time. The appreciation has come out of your estate. So we've not only removed some assets from your estate because we've gifted them away, we've also removed that appreciation, which again can be a very valuable tool, particularly if you have assets that are going to continue to appreciate in value. And splitting gifts means that spouses can combine their annual exclusion amounts and give $30,000 per person. When you split a gift, however, you need to report that on a gift tax return. So just keeping those things in mind if you do start to make gifts or have been making gifts over time. There are ways to leverage the laws, but there might be reporting requirements required. So the generation skipping transfer tax is one that we keep in mind if you are making gifts or transfers to a younger generation. Again, you have an exemption that you can use over your lifetime. But if you are making a gift to a grandchild or someone in a younger generation, which is defined as someone younger than 37 and a half years than you are. But oftentimes we see this a lot with grandparents and grandchildren. Just to keep in mind that this is a tax that can be assessed on transfers to the younger generation above and beyond your exemption amount. If you have multi-generational planning in your estate plan, the GST tax is something that should at least be part of that discussion and be addressed in your plan to, again, maximize the most that you can pass on to those grandkids free of this GST tax. We use trusts for that. So as I mentioned before, we have the federal estate tax. There are certain states that also assess their own state level estate and inheritance taxes. And where this becomes important is if you still own real estate in a state that has its own state level estate tax, you may want to engage in some planning, again, to be sure that we can maximize what value can be passed free of that state's estate tax. So for example, Massachusetts has a very low threshold as far as state estate taxes. And we have a lot of folks here in New Hampshire who have come from Massachusetts and may still retain or own real estate down in Massachusetts. There may still be an estate tax assessed on the value of that real estate when the individual passes away, even though they're a New Hampshire resident. Massachusetts still has a connection to that resident up to the value of the real estate. So my only point here is to make sure that if you do have property in different states, that you speak with your counsel and your accountant to be sure that your plan is taking all of that into consideration. If you were in our session earlier this week, I talked about if you move from one state to another, You need to be sure that your estate plan is updated. And this is one of the key aspects of any updates to an estate plan, is to be sure that if there is still any state estate tax that may be in play, we utilize whatever exemptions or deductions may be allowable to minimize the taxes that are paid. So then we come to federal income taxes, and this is where I say I'm not an accountant, so I'm speaking very generally. But there are a couple of things to remember with respect to federal income taxes. The first is that if you establish what we call a grantor trust or a living or revocable trust, which we talked at length about in our last session, those are considered grantor trusts. And what I mean by that is that the grantor is still the owner of the trust and all of the trust assets. And as a result, any income that is earned by the trust during the grantor's lifetime will be taxed to the grantor at the grantor's individual income tax rates. We might use what we call irrevocable grantor trusts to leverage not only the gifting opportunities that are available, but also take advantage, if you want to call it that, take advantage of the federal income taxes that may have to be paid, because someone's going to pay that tax, right? So an irrevocable grantor trust might be a trust that we set up. It is technically not part of your estate for estate and gift tax purposes, because you've given an asset to an irrevocable trust. You've removed the value from your estate. It's a true gift. It's out of your estate as well as all of that appreciation. But trusts pay an income tax at a much more compressed rate, meaning a trust is going to reach the highest income tax bracket much faster than an individual. So again, nobody wants to pay more taxes than they need to. So sometimes what we will do is set up a trust that is a completed gift for gift and estate tax purposes. The appreciation is out of the trust, but the income that is earned on that trust is still taxed at the grantor's level. So the income comes back to the grantor only for income tax purposes. You don't actually receive any income out of that trust, but you pay the tax on it, which seems a little counterintuitive, but generally it's a better net outcome with respect to those income taxes that are paid, because again, individuals are going to probably be at a lower tax bracket, or they're quite wealthy, and you're going to be at the maximum tax bracket, but trusts get there a lot faster. So this is always a good discussion to have, not only with your estate planning attorney, but also your accountant, to be sure that you understand what are the income tax implications of such a trust. Beneficiaries of a trust. So we set up an irrevocable trust. There are beneficiaries, or you have set up a grantor trust and have passed away, and your beneficiaries are going to be receiving distributions of income over time. Beneficiaries typically will pay income tax on the income that they have received. If they receive a distribution of principal, that is not going to be taxed. But the important part of this slide is just to, again, remind you that there are different ways to utilize the income tax laws, and also to be aware that beneficiaries may ultimately have to pay some income taxes on income that's been earned. So the other point that I wanted to, sorry about that, technical difficulties. So the other thing that has changed recently is what we call the Secure Act. This actually occurred and is effective as of January 1 of 2020. And it stands for Setting Every Community Up for Retirement Enhancement. And really the important aspects or changes under the Secure Act are how they apply to IRA distribution rules. So if you have an IRA, you probably know that there's a certain point in time where you need to start taking minimum distributions out of that IRA. It used to be 70 and a half was the start time. That age has been increased to 72. So you don't need to start taking distributions out of your IRA until you reach the age of 72. The other significant change to IRA distribution rules under the Secure Act is that the person who is inheriting an IRA has to take certain distributions over generally a much more compressed period of time. So we used to be able to stretch those IRA distributions out over the lifetime of the beneficiary inheriting the IRA in certain circumstances. Now, most of the beneficiaries who are inheriting an IRA are going to have to take distributions out within 10 years. And you might have a beneficiary who's going to stretch those distributions out over 10 years. You might have a beneficiary who wants to take a lump sum distribution in one of those years, or maybe year 10. So there are income tax liabilities associated with any IRA distribution. So inherited IRAs and the beneficiaries of those IRAs really need to understand what the income tax implication will be as a result of inheriting an IRA. There are certain beneficiaries who are exempt from that 10-year rule, we say. Those might be including a spouse. So a spouse can continue to roll over their IRA. A person who is not more than 10 years younger than the plan participant, the person who set up the IRA. A minor child is exempt from the 10-year rule. So a minor child of the plan participant, I don't believe that this extends to grandchildren, I'm pretty sure it's just children. So a minor child would not need to start their 10-year payout period until they reach the age of majority. And that varies by state. So some states consider 18 the age of majority, some states consider 21 the age of majority. I've actually seen some commentary where 26 is the age of majority. So again, the beneficiary will need to know when their 10-year clock starts ticking. And also people who are either disabled or chronically ill. And those are both phrases that are defined in our Internal Revenue Code. So again, if you have a beneficiary with special needs, for example, or someone who is chronically ill, who might be receiving the benefit of your IRA, you want to work with your counsel to be sure that you are naming that beneficiary in an appropriate manner to make it clear that that's who your eligible beneficiary is. And if you have trusts that either were intended to receive distributions from your IRA or maybe named as the beneficiary of an IRA, you really need to review the terms of those trusts with your estate planning counsel to be sure that they still qualify for this 10-year payout rule. Or if you have beneficiaries within those trusts that either are disabled or chronically ill, there might be a way to take advantage of the eligible designated beneficiary rules and have that distribution to the trust be exempt from the 10-year payout. And as Leanne had mentioned earlier, healthcare expenses are deductible in certain circumstances. So your CCRC entry fee may be refundable, and your CCRC entry fee may be deductible on your income tax return as a prepaid medical expense. Only the non-refundable portion of the entry fee is going to be deductible. And anything that might have been deducted and then is a return of capital after you pass away or after it's been refunded could be taxed as income later. So you want to be sure that you only deduct the non-refundable portion of that entry fee. And your monthly fees paid to your CCRC may also be deductible. It really depends, as Leanne had gone through a little bit earlier, depends on the type of contract that you have. The healthcare expenses are still deductible if you itemize, right? So if you itemize your taxes, you can deduct medical expenses exceeding 10% of your adjusted gross income. And this is where accountants become really helpful and allow you to deduct a portion of those CCRC fees. However, recent changes in our tax laws have really increased the standard deduction, and the numbers listed here on the slide are the 2021 standard deduction rates. So if you fall within the standard deduction, you may not decide to itemize, and therefore the CCRC fees will not be deductible because you're not itemizing. So sometimes with accountants, we'll run through the numbers and see if it makes more sense to take the standard deduction, or does it make sense to itemize? And it may, as a result, make sense to itemize at least the first year you enter the CCRC, given that entrance fee. And if it makes sense to deduct, that would be the year you could do it. And I just wanted to point out that your adult children may be able to pay the entry fee or a portion of it and be entitled to a tax deduction on their own income tax return. But there are other factors in order to qualify for that deduction. So again, just a thought to throw out there. But there are various factors that one would need to review with their accountant to see if this is an option for you or not. So I know we've gone over a lot of pretty technical information, but what have you learned today? So please take the following away from this discussion: that the federal estate gift and GST tax exemptions exist, but they're quite high right now. At least for now, but keep an ear to the ground, listen to news reports, what's happening in Washington. If you have any questions, reach out to your estate planning counsel and accountants. They'll be able to counsel you as to whether or not you should engage in any updates to your estate plan. Portability hopefully will remain for quite some time and is available to simplify some tax planning. So maybe you have some really complex tax planning that was put in place several years ago when the exemptions were a lot lower than $11.7 million. You might be able to simplify your planning using the portability option. State taxes may still apply to your estate. So even if you're not a resident of a state, if you've moved from one state to New Hampshire or another state that does not have an estate tax at the state level, but you still own real estate in another state that does, you really want to review your plan to see if there are any exemptions that you can take advantage of. And gifting is always a good part of an estate plan if it makes sense. But gifts can mean different things. So you might be able to leverage your gifts in a tax efficient way. Check your estate plan, particularly if you have a trust named as a beneficiary of an IRA. In light of the recent Secure Act changes, you still want to be sure that if you have a beneficiary of a trust who is going to inherit an IRA, that it is, the distribution can be stretched out as long as possible to maintain flexibility. And your CCRC fees may be deductible as a prepaid medical expense. And I appreciate everybody's time today. I'd be more than happy to try and answer your questions on these topics, either now through the chat function, which I think Leanne will walk you through, or later, if you think of anything, my contact information is here. So feel free to reach out. Thank you.
So we do have some questions rolling in, Jennifer, so I'll start reading them now.
Great.
First one came in, says each member of a couple can leave $5 million free of an inheritance tax.
So each couple right now, under current law, each of you has $11.7 million of an exemption. So together, whatever that math is, I'm a lawyer, I don't do math, but about $23 million can be given free of federal estate gift and GST tax. So your combined exemptions of $23 million and change is available. If you make any large gifts and you start to chip away at that $23 million, you certainly can. That's a lot to work with. But those are the figures that we can combine. The exemption amounts are scheduled to go back down to $5 million per person in 2025.
So we have a few years.
We do, hopefully, unless
right.
There's a change in the law. It's anybody's guess.
Okay, another question says the gift amount used to be $20,000 per year per person, correct? Now it is $15,000, you said. When did it change, if this is true?
Yes, so it's been $15,000 for about 3 or 4 years now. It used to be $10,000, and I think we had a year where it was 11, 12. So the $20,000 figure that you're thinking of perhaps was you combining or splitting your gifts. So you each had a $10,000 exemption amount, annual exclusion amount, excuse me, which is the amount you can give free of gift tax in any particular year. So if you gave in a year where the exclusion amount was $10,000 per person, that's probably where the $20,000 figure is coming from. But right now it's $15,000. It's been that for a few years, and depending on what our inflation rates head toward, that might be adjusted again next year. But right now it's 15, and it's been 15 per person for a few years.
Perfect. Thank you for clarifying that. Another person asked, in the stretch IRA, I see you have a 5-year payout crossed out. Was that the rule until December 31st of 2019?
Good question. So it was with respect to certain beneficiaries. Yes. So there used to be a rule that a trust, for example, was named as a beneficiary and it didn't have certain provisions in it, the trust itself would have to take a distribution within a 5-year period. Other beneficiaries may have to take a distribution over the course of 5 years as well. And again, it's depending on the beneficiary. But yes, it used to be 5. Now it's 10, pretty much for anybody, unless they are one of those eligible designated beneficiaries.
Perfect, thank you. Another one came in. It says state and federal guidelines seems to change with each administration. How often should you review your documents to attempt to keep up?
Great question. That's an excellent question, actually. So I recommend everybody review their estate planning documents every at least 5 to 10 years for a variety of reasons. One, to make sure that the folks you've named as agents and trustees and executors still make sense in those roles, but also to review any tax planning that you may have that can either be simplified or needs to be adjusted or addressed. So the 5 to 10 year window works pretty well, but you're right. There are changes. There's constant changes to, our administration, our Congress. That's at least every 2 years, right? So, reaching out to your counsel whenever there's a major change in government is fine. I've been fielding a lot of questions, particularly last November, December, as it became clear, that we were going to have a change in the administration. So, your counsel, your planning attorney, your accountant, who you're probably meeting with pretty regularly, might be able to advise you as to whether or not it makes sense to reach out to your estate planning attorney and adjust any of your plans. Or you just hear something in the news and have a question. Certainly reach out. It may not apply, it might, and just kind of keep an eye on, what's happening and see if there's anything that you're concerned about. If it triggers a question in your mind, then it's certainly something you can raise with your either estate planning attorney or even your accountant when you're preparing taxes with them this year, as we all are getting ready to do, right? They may have some thoughts, and if they're involved with your planning, they can give you some good advice as well.
Yeah, thank you. I think that's very, very true, right? You got to take it out and look at it every once in a while. You can't do it and 30 days later pull it back out again.
Not a bad idea, but it's good if you don't have to.
Yeah, exactly. So I guess I have one little quick question, if that's okay. So you mentioned if somebody moves from Massachusetts into New Hampshire and keeps property in Massachusetts. What if they've always had a second home, so to speak, quote unquote, someplace outside of New Hampshire? Do they have to pay state tax on that piece?
So it really depends on the state, but we'll use Massachusetts as an example.
Okay.
In Massachusetts, assesses an estate tax on any real estate owned by a non-resident if the value of the estate is over $1 million. So what I mean by that is you may not ultimately owe tax to Massachusetts depending on the value of that real estate, but you may still need to file an estate tax return in that state. But yes, so certain states will still say, Maine is another, that will say, even if you're not a resident here, you are now a resident of New Hampshire. Welcome, it's a wonderful place to be. But you still own that home, be it a second home or any sort of real estate, raw land, located in that state that has their state level estate tax. You may very well end up, or your estate, I should say, may very well end up owing a tax, or at the very least having to file something with the state to confirm the value is not at a level where a tax might be required.
Perfect. That makes total sense. Thank you. So I don't see any other questions coming in. So thank you for your time. Just want to mention to everybody that there will be the third part of the series next week. So if you have already signed up, fantastic. If you want to join us, please feel free to do so, online, or we also have a new event that's going to be coming up. I think there might be one more slide, Jennifer. There we go. So our next presentation coming up is Don't Be a Victim, How to Protect Yourself from Fraud and Identity Theft. Such a big topic, I think, nowadays. I just heard yesterday or this morning that people are trying to scam with the vaccine. I don't quite know how they managed to get that in there, but they're pretending that there's somebody from the state level and asking questions. So I think this is a very pertinent topic for any seniors and anyone actually to protect yourself. So that will be coming up Thursday, February 18th at 10 a.m. If you're interested, you can jump on our website to join, or you can call either myself or Jen, and we'd be happy to help you out as well. So there's no more questions. So I want to thank you for your time again, and we will see you again next week.
Thanks, everybody.
Have a great day, everybody.